Nice to meet everybody again. We continue our course, Corporate Finance, and today we have the topic of critical importance, and this is corporate cost of capital. And as you see here from that slide, the outline is really big. So we need to remind to ourselves that we need to understand corporate hurdle rate. And then step by step, we will go by the components of the corporate hurdle rate. We'll at first discuss cost of equity, and then we will move towards some elements of the cost of equity, and we should discuss the so-called risk-free asset and the returns on the risk-free asset. And of course, we also need market risk premium and how it could be chosen. And then we will switch to the questions about the comparability of developed and emerging capital markets in terms of the understanding and determining the cost of equity. So that's why then we will also discuss so-called segmented markets versus so-called integrated capital markets. And then we make a decision how we should adjust capital asset pricing model to these very different types of capital markets, the developed capital markets versus emerging capital market. And then we introduce the so-called hybrid capital asset pricing model as well. And finally, we will switch to the cost of debt. And we ask a very important question: why do we need synthetic cost of debt? And why it should be like homemade cost of debt? And finally, I would like also to introduce you some very specific and really simplistic model to provide you with some instrument how we can minimize the cost of capital and how we can model very simplistically for the minimum cost of capital. And this would be the end of the story of corporate cost of capital for today, because we are now in an open content part of our course. And of course, all the examples and all the case studies will be provided in addition to the topic. So the first point of our plan, of our outline, the corporate hurdle rate. I would like to remind you that in the topic number 1, I already introduced the very important difference between two approaches to financial analysis of any company. We talked at first about so-called accounting-based approach. We talked then about the so-called finance-based approach or corporate finance-based approach. And when I introduced the second one, corporate finance-based approach, I was talking about economic profit or residual income as a metric to make a judgment about the corporate performance. And here in that slide, I am going to remind you that for that particular metric, it was really very important to understand the so-called spread, economic spread, which is the difference between the return on capital employed, which actually the company already earned, and it should be derived from the financial statements of that company, and the so-called benchmark rate, or corporate cost of capital. So today we are going to explain how we are going to determine the cost of capital, and that is of critical importance because according to the principles of corporate finance, we can understand corporate performance only if we apply corporate finance approach, which is based on the difference and on the comparability of actually earned rate of return on capital with the required or expected rate of return on capital employed. So the second very important point says that if we already arrive at the hurdle rate of a company, if we already now should know how to understand and how to determine the corporate hurdle rate, then we need a lot to understand about the investors' expectations about the spread and how these expectations about the corporate spread or the difference between actual rate of return and the expected or required to compensate the risk rate of return, how this particular spread can impact the market values of the company. That's why this is really of critical importance, because investors should perceive whether the spread would be positive or spread is going to be negative. In case of positive spread, the market prices per share would increase. In case of negative trend in spread, the market prices per share may decrease. So the third very important point said, if we already understood how we calculated the overall cost of capital for the company, which is the benchmark rate or hurdle rate, then we now know the opportunity cost of capital for a firm. And we also should know that the hurdle rate or benchmark rate, of course, depends on the operating risk measures, and it also depends on the capital structure. Both types of risk matters for the level of the hurdle rate of the company. The basic approach is now represented at that particular slide. What would we see here? We see weighted average cost of capital. And we can also at first say, wow, it's really simplistic. This is like weighted average value because we are comparing two different types of investors, those who are providing debt capital and those who are providing equity capital. Both types of investors will have their own expectations about the risk level and about the required rate of return to compensate their risk. So the risk for debt holders would be a bit lower than the risk for equity holders. So we need to understand those investors' perception. So on the right side of that equation, which looks really very simplistic, but it's not simple at all, we may see the investor's perception. K with the symbol D, K with the symbol D, stands for the cost of debt, which is a description of the level of the expected required for to compensate the risk return for debt holders. And K with the symbol E is for the cost of equity. Those are opportunity costs of each types of the investors. They may invest in the market with this particular expected rates of return. And when trying to invest into that particular company A, let's say, they also apply their opportunity cost of capital. So on the right side of that simplistic equation, we first see the expected perceptions for the compensation of the different perceptions of the risk, the differences between debt holders and equity holders. What we else can see on the right side of that equation? We see WDWE, which stands for the weight of the debt capital in the capital structure of the company. And WE stands, of course, for the equity capital and the weight of the equity capital in the capital structure of the company. Remember, in the previous topics, we already discussed the determinants of the capital structure of the company. We already discussed that capital structure shows the financing policy for the long-term period to solve all the strategic problems of the company, how the company is going to finance the corporate strategy approach. So we now see that on the right side of the equation, there is a combination between the perceptions of the risk of different types of investors and the proportion of that particular type of the capital inside capital structure. I would like also to remind you, and that is shown on that slide, that that proportion between debt capital versus equity capital is better if it's calculated or estimated on the basis of the market values, at least on the basis for the market value for the equity capital. Why I'm saying at least? Because equity capital is publicly traded. So we are now talking about open company, about publicly traded company. So it has market prices per equity shares. But even this publicly traded company may not have corporate bonds outstanding. So it will mean that company doesn't have market prices per debt securities outstanding, current market prices. So in that particular case, we cannot express the market value of debt basing our estimations on the current data about the market prices of debt securities of that particular company if it doesn't have those securities outstanding. So if it has only bank loan but not corporate bond outstanding, so it doesn't have those market prices for debt capital. So that's why I'm writing here on that slide. The capital structure proportion between WD and WE should be estimated even if we don't have corporate bonds outstanding on the basis of the market value of equity capital. On the left side of that equation, we see the result of our arithmetic calculation. This is weighted average cost of capital. We already mentioned this is an approach how we are going to compute the hurdle rate for the company. And this is the benchmark for the management team, because this is the rate the company should reach. This is the minimum level of the return on capital which is invested, which is employed in the company. And at the same time, this is the opportunity cost of capital for that particular firm. If that particular firm is going to invest, it must overcome that hurdle rate. It must at least produce the profit, which would be when we compare the profit to the capital, and we will get the return on capital. The return on capital should be at least equal to the WACC, to the weighted average cost of capital of the company. So we looked at that equation, and it looks like very simple, but despite its simplicity on the first glance, this is really a very powerful equation, because it says how we are going to estimate the return which is satisfying the expectations for the risk-return trade-off for all types of the investors of the company. Second, we already said, and I'm repeating it again because it's very important, of critical importance, this is the opportunity cost the company has to bear in mind when investing, in case the company is still investing with the same operating and the same financing risks. If operating risk or operations and operational policy of the company is going to be changed, let's say the company is introducing new technologies, the company is entering new very important markets, and the company is entering new competitive decisions. So in that case, the operational risk may change, and maybe the company is also going to change its capital structure policy and financing policy just to be successful in these very new conditions, competitive conditions for that particular firm. Then this slide says to us that if the operational risk changes or financing policy changes, then we should expect the change in the hurdle rate, the change in the weighted average cost of capital. So the weighted average cost of capital, this is a benchmark to decide whether the company is creating value, whether the performance of the company is value creating or it's value destroying. And we should apply that criteria, that approach, to compute the weighted average cost of capital and to compare the weighted average cost of capital to the capital, to the return on capital employed of any company, even in case of closely held or even family-held firms. And of course, in any industry, in any sector of the business. And finally, that's also very important to understand, this is not only the benchmark for the business, for the company, for the entity, for the firm. This is a benchmark for the professional success of top management team to make a judgment whether they are successfully running the business or not. Because if the business is value creating, it means the professional team is really successful. But if it's not, and the business is value destroying, then it means that the top management team is not professionally successful at all. So the power of the cost of capital is really significant, is really important, despite the formula looks like very simple. Now we are moving to cost of equity, and that is like a reminder. I'm not going to explain in details the overall concept of asset pricing models. Why? Because in our open content specialization and of course in our degree program, we have theory of finance, which should be studied first. And in the course of theory of finance, the participants would understand precisely capital asset pricing model. That's why here I would like to discuss only a type of a reminder. So what is asset pricing model, which is shown here? This is capital asset pricing model, or CAPM. So we see here from the first equation that the expected return of some company I is comprised of two different components. The first is the so-called investments in the risk-free assets, which will bring to the investor the minimum rate of return, which is risk-free rate of return. And the second is a product of the market risk premium, which is in brackets here, and the beta of a company. And the beta, this is standardized risk measure of a stock. This is the slope of the regression curve when the analyst is trying to compare the portfolio rate of return, which is RM, market rate of return, and how it changes through time in the past, with the concrete or actual rate of return of that particular company I for the same periods within the same intervals. So building the regression analysis, the analyst will get the sensitivity coefficient, which is standardized risk measure of a stock sensitivity to the changes in the risk level of the well-diversified portfolio, which is market rate of return. So the beta, this is very important parameter with very important metrics in financial analytics, because we can say that the beta just shows the systematic risk coefficient for any company, because the market rate of return, this is the return on well-diversified portfolio. If we assume it's really well-diversified, then it means that the portfolio includes or contains only systematic risk, and all unique risks are diversified away. So the sensitivity to the changes in the return on that well-diversified portfolio means the sensitivity to the systemic or systematic risk which exists in that economy, in that capital market. So we see that expected rate of return, according to the idea of CAPM, depends on the beta. And of course, it depends on the risk premium for investing in equity, in stock. The beta, this is the measure for particular company. And the risk premium, which is in brackets here, this is the measure of systemic risk premium within this market for some particular period in time. So the classic assumptions of capital asset pricing model, CAPM, I would like to remind them again. The model was built only for one period. According to the principles of the model, all the investors are really risk averse. According to the model, they all have homogeneous expectations because they should perceive the risk levels just identically, and they should think about the expected compensation for the diversifiable as well as undiversifiable risk in the same manner. Within this model, we also have to assume that there is some risk-free asset in that particular market. And if it exists, then the market risk premium, which is the difference between the rate of return for well-diversified portfolio, which is market rate of return, and the risk-free asset return, then that premium also actually exists in this particular market. All the assets which are traded here, risky assets, they are all divisible, which says that it makes the life of investor much easier because they are all divisible. The investor can buy any amount of those risky assets as he or she wants. We also need to assume the conception of the perfect capital market, which means there is no private information. All the information is equally distributed within the market, and the access to the information is really equal in the market, and the investor also can get any type of existing information which is equally distributed in the capital market without transaction costs. We can see that this is like ideal, a list of some assumptions which may not 100% exist in some particular concrete capital market. But it always happens in finance because we need some model, and the model assumes some ideal assumptions. So what are testable implications of CAPM? According to the equations we already discussed in the previous slides, we need to repeat that expected returns on all risky assets should be linearly related to the betas. And the market premium, which is the premium for investing in equity as compared to the risk-free asset, is of course positive, which means that the risky assets should bring higher returns than the risk-free assets in these particular markets. The model also assumes that there are no significant factors that are not related to the beta of a stock, which can influence the expected rate of return. And that's why we're back to the first point in that slide. All the expected returns are related to the betas, and they are not correlated with some other factors in the market. And that's why this is the beta which measures the sensitivity of the changes in the return of some particular stock compared to the changes in the market return or well-diversified market portfolio. So the beta is like a key or central matrix in that model which captures the systematic risk sensitivity of that particular company. And that's why we need to discuss the beta a little bit in more details. And that slide you see the adjustments introduced into finance by Hamada. And I'm not going to discuss the assumptions which are behind that particular adjustment, but what is shown here. Here we can see that the beta depends on the capital structure of the company. The beta depends on the financial leverage. So now we see that the beta of the company which is levered, which uses debt financing, is different from the beta of the company as if it does not use any debt financing. So the true beta, this is the slope coefficient from the regression, as I already mentioned. That's why it's called true, because it's derived from the regression analysis and it's based on the actual data about the return on the stock of some particular company, I or A, and as compared to the market rate of return for the same period of observations. So the true beta can be also compared to the beta unlevered. Beta unlevered can be used then in some particular analysis. So we can use the true beta as it's shown here on that slide to unlever it, to adjust it, and to get the beta unlevered of the same company. And this is the second equation. So we are now showing that starting with the true beta, we may arrive at beta unlevered of the same company. And that is very important. And the next slide shows why it is so important. Now we need to compare the true beta, which is derived from the regression analysis and is based on the actual sensitivity of the rate of return of any company which is publicly traded, as compared to the market rate of return of well-diversified market portfolio of risky assets. So if we now apply this idea in a manner which is shown here, we can get so-called beta bottom up. What does it mean? the beta bottom up could be get from this functional dependence in two steps. This functional relationship between beta of the company and its capital structure, which is represented in those equations by debt to equity ratio, this functional relationship permits for us not only to unlever the beta of any company which really uses the debt capital in its capital structure, but we can also at first use some comparable companies, and this would be our first step, and look for their true betas from their regression analysis based on their actual true data about the sensitivity of their returns on the stocks to the market rate of return. In the second step, we can unlever their betas and get their beta unlevered, which will capture only the impact of operating risks drivers, but not the impact of financing policy risk drivers. So we, after this step number 2, can get the beta unlevered for each comparable firm. Those companies should be comparable to the target company that we are trying to understand much better in terms of their operations, in terms of their operational policy, in terms of their product portfolio, their markets, their technologies, and the scale and the scope of those companies. So if we've got those comparable firms in some market, we can get their true betas. We then can unlever them and then can get their betas unlevered. And to go through the step number 1 and step number 2. The step number 3 says, now we've got their betas unlevered. And that's why it's very important. Now we do not feel any influence of the difference between this company, which could be due to the difference in their financing policies. Those companies are comparable. It means by assumption, by definition, that they are very comparable in terms of their operations and in terms of the impact of the operating risk drivers. And that's where the step number 3 we may assume. If we get the average beta unlevered from that very small sample of comparable companies, comparable in terms of their operations, in terms of the impact of the operating risk drivers on the required rates of return, then we can get the average beta, but it should be computed as weighted average beta unlevered for these comparable companies in our small sample. And we should assign those weights when computing weighted average beta unlevered according to their market capitalizations. And finally, at the step number 4, as I show here in that slide, we now can use this average beta unlevered derived from the step number 3 and put back the leverage for that particular company and put back the tax rate for that particular company. So you see here the equation number 2, which I put in red. This is the last step of our analysis. And that means we made that procedure. We found the beta bottom up. Why is it called bottom up? Because we started with the betas of companies which are comparable to the target one. So there was some reason why we didn't use the beta of the target company. What could be the reasons? Maybe this is publicly traded company, I mean the target company, but we are now in a process which says that that company is changing principally the company's profile and is going to be changed in many, many different dimensions. So we think that the true beta of that company, which is publicly traded, the target company, cannot be reasonably applied in our investment analysis, in the analysis for the future because the company is going to change operations, to change products, to change technologies. Or maybe the company already stepped into those changes. That's why it's not really a smart idea to use its previous periods of the business in the competition, because in the previous period, which could be used to compute the true beta or beta from the regression slope, in case the company is now changing dramatically the business profile. What could be the second reason that beta bottom-up will help us in our analysis? The second reason is really more tough, really more evident. If we are now looking at the company which is not publicly traded, but we need to understand the required rate of return on its equity capital. Now, the beta bottom-up could be used to understand the required rate of return of closely held company which is not publicly traded through the procedure of beta bottom-up. So I would say that in some situations, beta bottom-up, the result of these 4 basic steps, is better than the beta true of some publicly traded companies in case they are changing dramatically their strategy and their approaches to the business. We also need to discuss the CAPM and to refresh that discussion. And also we need to discuss the applications of beta in terms of how to improve the capital asset pricing model in practical sense to avoid some particular mistakes. And the first type of possible mistakes are related to the so-called estimation error, which can arise from very high level of volatility of the returns of some particular companies, and is the most important for some companies which are small scale companies because they are much more sensitive to the volatility in the business and to the volatility in the returns. So the research in CAPM, in capital asset pricing models, shows that there is a tendency towards industry average beta. And based on that idea, the researchers introduced so-called shrunk beta or adjusted beta. And they prefer to introduce the adjusted beta as weighted average beta. And the higher the standard error when we are making the regression analysis to find the true betas of many companies, the greater the tendency to that particular company to move towards industry average beta. So the shrunk or adjusted beta, which is weighted average beta, which should also comprise the industry beta. This is like a very specific instrument or very specific decision. For those companies which have their betas from the regression analysis with the highest standard errors as a component of their regression exercise, and also for those companies who have the highest betas, which will mean they are very volatile, they are very sensitive to any changes in the equity returns in the market. Though for those companies, their betas, their true betas, must be adjusted more intensively towards the industry. How it's done, I can illustrate at least by the Bloomberg adjustment. As you see from that equation, the weighted or adjusted beta or shrunk beta is comprised of 2 components. Unadjusted beta with the weight 0.66 and the market beta, which is equal to 1 by definition, This is from the assumptions of the capital asset pricing model with the weight of 0.34. So this is one type of the adjustment which says that we can apply that very important observation which comes from the empirical research that all the betas are moving towards the industry or market betas. For the small and medium-sized companies, the researchers would recommend, and Bloomberg also recommends, to adjust the beta not to the market beta, which is equal to 1, but to the industry, particular industry beta, but with the same weights as you see here. And the second type of the modification, just to improve the beta, which means improving the applicability of capital asset pricing model in the investment or financial analysis of any company. This is so-called the lag effect, which provides us with the sum beta. The lag effect is based on the observations that says that the prices, the share prices, they will react to all the movements in the market index, market for equity stock index, with some time lag. Only the largest, in terms of the market capitalization, companies will not react with the lag, but the smaller the capitalization of the company, the higher the lag with which those returns and those prices per share of these smallest companies react to the market changes. So given that approach, which means they are not simultaneously reacting to the changes in the market return, those different companies, then it says that the true betas, which are derived from the regression analysis, are biased down. They are less than they should be. So, and this effect could be stronger in case the analyst, when running the regression analysis, trying to find the true betas for some companies, is using so-called daily returns, not weekly, not monthly returns. And that's why the researchers also suggested that we can apply the so-called sum beta. And this is two steps procedure. On the first step, the analyst will run the regression analysis with the current market excess return for the same period and the current rate of return of some target company he is looking for. On the second step, he will again run the regression analysis, but now with the last month's market excess return, not current, but the current rate of return for target company stock. So he or she will run the regression analysis twice, and he or she will get two values for the beta coefficient. And then, after these two steps, the analyst may sum up those true betas or slope coefficients, the betas derived in both regressions, and it would become sum beta. And the researchers will state that the small stock effect could be partially explained if we apply this approach with the lagged beta or sum beta. And that is the so-called modified beta or lagged or sum beta. So we discussed some very important details in the application of CAPM and mainly beta coefficient. Now, continue this step of a discussion, I would like to make some very important, I think, comments on the risk-free rates. So the risk-free rate, it should be the return, which is really available on some particular security, which we can estimate as free of default risk security. And this return should be available as of valuation date we are now in process of analysis. And we also need to understand that because we are looking for this risk-free rate, and it should be free of default risk, of course, we will be looking through the debt securities, and mainly we will look at so-called treasury bills or treasury bonds on the securities which were issued by particular government of particular country. What else we need to say just in that introduction to the discussion? We should bear in mind that any debt security and also the risk-free asset has three different drivers behind the rate of return. First one is the so-called rental rate, which means that there is some return for lending out your money, your capital, to some company, to somebody, and that means that you are foregoing your consumption of this money, of these funds. The second one is due to the inflation, the level of inflation, because it will influence the expected rate of return over a particular period of the investment you are looking for. And the third, the last one, but not the least, means so-called maturity or investment risk, which says that during some period of investment, you will not only observe some inflation, but you may also meet the situation when the debt market may significantly rise or significantly fall within this period to maturity of your debt security. And that will mean that all these movements in the debt market will bring the dramatic changes in the interest rates in the overall debt market. So we mentioned these three very important components, and now we need to understand the results of these observations. How to pick up the return on risk-free asset? Of course, you may choose between treasury bills, which are short-term government debt securities, and treasury bonds, which are long-term government debt securities. Imagine we are in the first case. We would like to look at first at short-term rates or on treasury bills of some government. So if we apply the treasury bills as a risk-free rate, then applying further the CAPM model, the asset pricing model, we will need, of course, the market risk premium, which is the excess return on the market portfolio of risky assets as compared to the risk-free rate. So if our risk-free rate is based on the treasury bills, what we should think about? In that case, we need to understand that our investment horizon matters. And we need to differentiate between two opposite situations that may arise within the investment horizon. So when we are looking at the risk-free rate being the short-term rate based on the treasury bills, we are trying to incorporate it into the calculation of expected rate of return for the risky asset of some target company A, let's say. Then the market risk premium will, of course, be sensitive and will be dependent on that particular our decision that we are picking up the treasury bills but not treasury bonds. Why? The first situation, let's say, this would be the period of high level of inflation. The inflation is really high, is really sensitive to the investors, to the businesses, to the families, to the firms. The inflation is really high, and we also may observe that the central bank of that particular country should apply and already applied so-called extraordinary regulation of monetary markets and of financial markets. So if this is a combination, the case number one, let's say high-level inflation, then we should understand that the market risk premium will include the so-called premium for investment horizon. And finally, then, the cost of equity we are looking for, because we are applying the capital asset pricing model, CAPM, which says we need at first risk-free rate, at second we need market risk premium multiplied by the beta of some particular target company A stock. The cost of equity finally would be overvalued. In the opposite situation, situation number two, when we are in the process of low inflation levels, really very low and very stable inflation rates, and the central bank does not, of course, apply in that period of time some extraordinary measures or activities in its regulation policy. It's just ordinary, or let's say simple, everyday regulation. Then in that period, we will also understand that the market risk premium will have some discount due to the investment horizon. And then the cost of equity we are looking for, the target company A, would be undervalued. So to summarize what we already said with this particular slide, we should be very careful when picking up the risk-free asset and the rate of return on risk-free asset. And in the first case, if we really want to apply short-term rate, we need to understand that the overall result of our computations of the cost of equity would be very sensitive, depending on the period of our analysis. High inflation versus just stable, low, or regular inflation. And what is going to happen then if we still want to follow that particular conception to apply treasury bills instead of treasury bonds? The capital asset pricing model should be adjusted for that particular approach. In the first term you see in the right hand of equation how we should adjust the risk-free rate. We will pick up the return on the risk-free asset presented or represented by treasury bonds or long-term treasury risk-free asset, which is current, observable now at the point of our valuation analysis. But we should subtract the average bond bill return spread, the average spread between the return on long-term bond and short-term treasury bill. Long-term treasury bond versus the return on short-term treasury bill. Why? Because we want to get the risk-free assets represented by the short-term treasury bill, but it's the current value of treasury bill rate of return is very sensitive to the inflation level, as we already explained. So we need to adjust it, and subtracting the average, historical average spread between bond bill returns of the same government, we then will escape that negative error, that error in estimating finally the overall result, which is expected rate of return on some company stock. In the second term on the right hand of this equation, we see the market risk premium multiplied by the beta of the stock. And in that situation, because we are now discussing the case number 1, which is based on a short-term risk-free rate approach, we need to be aware that we are picking up the data for the market risk premium based on the comparison of the well-diversified portfolio or market rate of return for risky assets minus the risk-free rate, which is based on the treasury bill return. But again, this term, the second term, the market risk premium, should be based on the historical observations at least. So, to conclude, you see, we need to adjust both terms on the right-hand side of the equation. And maybe it doesn't worth doing this. So if we want to insist that we think it's really smart to apply treasury bills instead of treasury bonds, we need to be aware that we are following that equation. Finally, maybe the analyst will say, wow, I would like to get rid of it because this is too complicated. I'm not sure that I can find the market risk premium which is computed, which is estimated by some analytical agency, professional analytical agency, just comparing to the treasury bills. And I'm not sure that I'm going to find the average bond bill return spread. It's too complicated. It may happen this way. So, the rule number 2. Maybe we will not apply the approach previously discussed. That will mean that we would like to stick to the treasury bonds, which may have a very long maturity or duration for 10 years or even 30 years. And then our equation looks much nicer, because then we will get directly the rate of return for the treasury bond with some longer maturity. And the rule says that, of course, it's better if we can match the maturity for the treasury bond with the period of investment analysis and analyzed free cash flows, because we are looking for the discount rate for the free cash flows at that point of our analysis. And the second term, we will get again the market risk premium, which is the premium for investing in equity stock versus investing in risk-free asset. And here again, we should be aware that that risk premium was estimated compared to the long-term treasury bonds, but not versus treasury bills. And of course, the beta is also sensitive, because the beta could be sensitive to this excess rate of return over the risk-free rate. So I would say the second case, application of long-term rate approach, is much smarter and it's really much better for the different purposes of investment analysis. I can illustrate that, of course, it's not just theoretical vision. We can provide some empirical, very important evidence, as that slide shows at the moment, that the market premiums, which is the difference between the market rate portfolio and the risk-free asset rate of return, depends on the nature of the risk-free asset, whether it is represented by the treasury bills or it is represented by the treasury bonds. And you see here the empirical evidence provided by some group of researchers, and be attentive, this is for very long period, even longer than 100 years. And the historical risk premium is calculated with the means of geometric mean, with this particular type of approach for the so-called global portfolio. And you may see that in the column which represents the risk premium versus treasury bills, we will get very different estimates as compared to the column which represents the market risk premium for investing in equity stock, but in case we are applying risk-free asset as treasury bonds. From this follows, for us, for just practical everyday purposes, we should be very attentive to the data we are using, because you see, there could be some misunderstanding and there could be as well some mistakes. We also can look at some other research results. This is again the paper made by a group of researchers, but not for such long period of time as 115 years in the previous slide, but for much shorter period in time. And what we see here, again, the premiums which are comparing market rate of return to the return on treasury bills really differ from those which are comparing market rate of return for treasury bonds. What else is really important? So this again and again, a very important comment. We need to be very selective. We need to be very attentive. You see, we already discussed the beta coefficient as a very important component of capital asset pricing model, which we really need to understand the cost of equity. We also already discussed some very important details about the application of risk-free asset and the choice of risk-free rate. And now we are trying to summarize and also to talk a little bit about the market risk premium choices. And first, I would like to say that there are two very different approaches, or so-called schools of analysts, which are applied to understand the level of the market risk premium. The first approach is based on the idea of the historic approach to the data, or so-called ex-post premium approach. Within this school, I also should differentiate between the approach which is famous for the Ibbotson Associates analysts approach and the Chicago University analysts approach. They both stick to the historic school, and it means that they are really aware that to understand the market risk premium, you need to go to the past data and you need to observe the actually existing market risk premiums, and then taking those particular historical data, you need to understand the average market risk premium derived from the past data from the past period. What is different between Ibbotson Associates and Chicago University Analysts Group? Ibbotson Associates uses the Standard & Poor's 500 market index, and they are comparing the rate of return on the Standard & Poor's 500 to the treasury bond with a maturity of 20 years. But what is really remarkable, they are trying to observe the excess market rate of return over the 20 years treasury bond risk-free assets since 1926. This is the initial year which provides really a collection of data about the Standard & Poor's 500 market index and the treasury bond with the 20 years of maturity. So their philosophy says, let's look back as far as possible, as far as the data permits us to make all the systemic regular observations. Next, this agency, Ibbotson Associates, they are, of course, computing with different technique. They are using this time series of data, but they will apply arithmetic means, and also they will compute geometric means. And their observations show that the arithmetic mean technique to estimate the average market risk premium from the past data provides higher values for the market premium. As for Chicago University analytical group or analytical agency, they also, as I already mentioned, look to the past data, but for much shorter period. And they think that the period of observation should be limited by the so-called professional lives period of some particular individual investor who is trading every day or even every night in the capital market. And this is not, of course, for 100 years. So it's about, let's say, 30 to 35 years historical observations in the past. So the philosophy is very common for both technique, but the period is very different. And that's why we also need to understand what's better. If we look back for that data to compute the market risk premium, whether we should stick to some recent history period or we should follow the Ibbotson Associate conception and look to the long-term period of time. Each of the approaches will have the pluses and minuses. If we look at the recent historical data, we will also say that, of course, there are some advantages because this is the period the most familiar for many investors, the most relevant for many real investors in the capital market. We may also say that if we look for much longer period of time than some recent history of observations, the return patterns may change because the economy itself could be very, very different in these longer periods. And we may also face the situations when within the much longer periods of the observations, we will observe very unusual events, very dramatical, not regular, but extraordinary events, of course. They will impact the market rates of return and the market premiums as well. Compared to the long-term history period, it also has some very serious advantages. Those who are making the research with the long-term history period, they arrived to the very important observation about the surprising stability of the data within this long-term history periods, or say longer-term periods. They also will say that yes, if you focus just on the very recent past, you may not face some very unusual events. But if you focus on the longer term periods, you may meet these unusual events. But then, looking for the longer periods, you will just observe the data, which shows, let's say, some learning experience of investors. Say it in other words, if you apply a longer term period, then maybe you have an argument saying, wow, investors, they should be very flexible. If something is going to happen very unusual in the nearest future, they need to be adjusted to these very irregular, unusual events. Looking for the longer periods in the past to derive the average market risk premium, you are trying to say that you are looking to the memory of the investors, to their behavior, and which just comprises or which has some component of learning experience. This is their argumentation. And the last but not the least, the longer the period, the higher the number of observations. And the highest number of observations may provide more accurate statistical estimates. So we see that both approaches, recent versus longer-term history, may have some advantages, may have some disadvantages. We also need to discuss whether we need to understand and to pick up the market risk premium, which was computed on the basis of arithmetic mean, or we need to stick to the geometric means. Again, we need to understand pluses and minuses. The arithmetic average has, of course, some advantages because this is year-on-year market risk premium compared to each other. And you could say that this is really a very smart approach, especially in case when year-on-year the stock returns of that particular market are not correlated over time. If there is no evident or significant correlation over time, then the arithmetic average has some advantages over geometric means. Next, very important argument of those who want to follow arithmetic means versus geometric means. In case you are applying arithmetic average, the most accurate approach would be then to make the forecast of your future cash flows, because you are now looking for the components of discount rate for your future cash flows. But then your future cash flows should be forecasted with the probability distributions. If you combine this, the forecast of future cash flows based on the probability distributions of possible outcomes or expected values of the free cash flows, and the arithmetic average of market risk premium as a component of your cost of equity analysis, then this would be the smartest, I would say, the most reasonable approach. How about the drawbacks of arithmetic means as compared to the geometric means? Arithmetic average mostly fit the single period model, but not multi-period models. And of course, then we all already saw from some empirical data in the previous part of our class that arithmetic mean is likely to overstate the market risk premium. How about geometric means? The geometric means also have some advantages. Of course, if you look at the past, you may see that some periods of time in the capital market with the high rates of return on stock are followed by the much poorer years when the rate of return is much lower. And it says that the rates of return on some stock, on many stocks, could be negatively correlated. And then historic mean is not good, because historic mean, this is the technique which considers year on year. Then geometric average is much better, so it's smoothed and it fits better to the real data, which shows that negative correlation between different periods of time, good years versus poor years in the capital market. Next very strong advantage of geometric mean says that due to the technique of that particular approach of calculation, the market risk premium based on the geometric means better fits multi-period valuation models. Multi-period means not only many years, but the periods which the different dynamics for this valuation approach. Does it have the drawback? Yes. We also may say that it has the drawback because many researchers would argue saying if you apply geometric mean, then you have to assume that the equity risk premium in the future, because you're looking for the future in that in the evaluation, in the investment analysis, the equity risk premium should be the same within all the future periods. So this is controversial discussion. Each approach, arithmetic and geometric means, have their pluses and their minuses. And then everything depends on your analytical culture, which particular approach you really want to follow to escape the most errors you can escape. To continue our discussion, how to choose market risk premium, we already discussed only one historical school, but an opposite, there exists also the so-called forward-looking or ex-ante market risk premium school. Within that approach, forward-looking, we can also differentiate between two particular techniques. They both are looking forward, they are looking to the future, not to the past. Actual data as Ibbotson Associates or Chicago University lab. But again, they may differ in their particular technique. The first technique is so-called bottom-up based on the dividends forecast. And you see the names, these are really big names. Goldman Sachs Investment Bank, Global, very famous, Merrill Lynch Investment Bank, Credit Suisse, First Boston, Alcar, they are all investment banks and they have really very important, very significant experience. They are very professional, very experienced. What does it mean, this bottom-up approach? Looking at that formula, we can say they are making the forecasts for the dividends for the next year, dividend with the symbol 1, looking from now for many companies which would be included, let's say, in the index Standard & Poor's 500 or in the index of New York Stock Exchange, whatever. They are also forecasting their price to earnings ratio or PE coefficient for the next period. They are also making their estimates about their growth rates. So they are forecasting R or required rates of return company by company. And then they are just collecting them, that's why it's called bottom-up, from different companies up, making the index, and finally getting or deriving the value for the overall index for the future, but starting from the forecasts of different companies from the bottom. We also may look at an opposite technique within the forward-looking premium school. Opposite means not from bottom to up, but vice versa, from top to bottom or top-down approach. It means, let's say, Value Line, JP Morgan, Kidden, PBD, and some other agencies, they are directly forecasting the values for the market index. They are not starting forecasting just particular dividends, particular growth rates, particular PE coefficients of different individual companies. They are looking just overall to the market index, trying to forecast the macroeconomic trends, the trends in the capital market, and trying to understand the overall rate of return on the market index. You can understand these are very different approach, and you may see that they will bring different values for the market risk premium. Again and again, How about the particular person, particular analyst, or particular analytical company in case you need to provide the business analytics? And you need, of course, your cost of equity, and you need then weighted average cost of capital, and cost of equity is a part of the weighted average cost of capital analysis, as we saw before. It's up to our own decision. We may follow the first approach, historical school, or we may follow the forward-looking premium school. But we should not combine like a mixture in one type of analysis the data which we can collect from these both very different approaches. That's important to remember. We discussed many things about the components of equity pricing models. So now we need to move forward. In the next point of our class discussion, I would like to provide with the differentiation for the cost of equity in emerging markets. Why we need to think about modifying the capital asset pricing models just for emerging capital markets. Of course, it's due to the very critical features of emerging capital markets as compared to the developed capital markets. At first, we need to remind ourselves that among the assumptions for the capital asset pricing model, there is an assumption about the efficiency of the capital market in terms of the information flows. The emerging capital markets may have much lower or much weaker forms of efficiency. It could be based on the argument that they will have just limited information flows, not very many information, not very many data regularly collected. This information may be unevenly spread between different types of investors, so there would be no symmetry of information flows between the investors. It may mean that some investors will have much better access to the information than some other groups of investors. The requirements to disclose the information in the stock exchanges of emerging capital markets may be still different in terms of the quantity, quality, the scope, the extent, the volume of disclosure as compared to the developed capital markets. And finally, the data about the market returns, about different rates of return from different periods of time may not be really well classified, not very much studied on the regular basis. And we may not say that on all the emerging capital markets there is a sufficient quantity and quality of market researches. Next, we also need to remind ourselves that in emerging capital markets there could be some difficulties or barriers in the process of diversification of risk. Remember that capital asset pricing model stays on the idea that the unique risks of different companies' stocks could be and should be diversified away. And then the main and major and even the key driver of the expected rate of return would be based on the market risk premium and the beta, which is the description of the sensitivity of the company stock to the systematic risk of the market itself. But if you cannot diversify all the unique risk because of some obstacles, objective obstacles in the market, then the model is not very true, is not really smart for that particular environment. The difficulties in diversification of risk may be due to the small capital market size. Not many stocks are represented. The market could be also narrow for each company. Not many shares are outstanding, are circulating in the market. There are no big volumes of public offering, initial public offering, seasoned or secondary public offering in the market. So some strategic deals in the market to buy and sell, even control package of the stock and market control over the companies are not very regular in the market. They are going in some waves with really big periods of time when no strategic deals is made on the market. We may also say that difficulties in diversification may arise from the high transaction costs for many investors. Of course, different emerging capital markets between themselves also will differ by all these arguments and criteria. But as compared to the developed ones, they may all have much more in common than we can observe between the emerging capital markets inside that group. We can also then say that among the critical features of emerging capital markets in terms of the investment decisions, in terms of the estimations of the required risk of return, we should think about the country risks. If the market is narrow, if it's very volatile, there are some drivers behind the country risk. It should be, and it could be, the risk derived from purely political or social conflicts in some economies, in some countries. Even in some situations, it could be the risk of expropriation. It could be the risk derived from the barriers to expatriate your money that you earned here within the operations in the capital markets. It could be due also to the depreciation of the national currencies in many emerging capital markets. And of course, it could be due to the default risk in public debts or treasury bonds and treasury bills in those countries. And of course, the higher or hyperinflation risk may be also a very important component of the country risk. So there are different approaches how the researchers are continuing studying the level of the country risk in many countries, and especially in emerging capital markets. Why in especially emerging capital markets? Because of the difficulties to diversification. So among those approaches, we at first can say that there are some quantitative methods, and it's based, those methods are based on some specific models, mathematical models, functional models that will be, of course, based on the country trends and the country data, country variables. There would be some functions built by the analytical agencies, and we may just believe or not believe to the final estimates, because we can be aware that there are some advantages as well as disadvantages of the quantitative approaches to study country risk. Among the disadvantages, we may say that not all the functions may incorporate all the qualitative factors and all the qualitative data. Sometimes it could be really impossible. Next, we will say that they operate with the actual data. That means that they are looking backward, not forward. So they are bringing into the table, into the analysis, the data from previous periods. We already discussed a historical approach to the market risk premium. And we also said that if you look just to the past data, you can face some very unusual periods of time in terms of the investor perception. Here we can say that we can observe some very unusual events or drivers of the country risk in the past, which may not appear again in the future. And of course, this is the mathematical function, and it has some particular amount of variables inside the model. So the criteria to select particular variables and their values could be also not very much clear. So these are potential disadvantages of the quantitative methods. From that follows that, of course, there is an opposite approach, which is so-called qualitative technique to study the country risk. It is based on the questionnaires, on specific grades that the experts will assign to some particular drivers of the country risk. Through the questionnaires, you can assess the country risk, you can assign some ranks, you can provide some scales. And these questionnaires will describe several groups of factors, and then respondents will just put their marks. They can put their particular grades, and finally the data would be summarized and finally assessed. And at the final step of that particular type of an analysis, the experts who are running that type of an analysis, they may finally assign the particular level of a country risk starting from the low, then go into some medium levels and up to the highest levels. What are about the disadvantages of that qualitative approach? We may say it is really more subjective because in many situations we cannot just really very good explain the scales and the ranks. They could be too straightforward, they could overlap each other, so on and so forth. So because both approaches, they have their weaknesses and their strengths, many specialized institutions which are keen on running that particular analysis of country risk, they will try to combine both approaches. In that table, in that list, I'm trying to show you that, let's say, Bank of America, World Information Services, they are applying so-called mixed approach. Mixed means that those analysts, they try to combine qualitative with the quantitative, trying to escape as much as possible mistakes in their assessment. But still, there are some agencies which are applying just only one. Let's say International Country Risk Guide applies quantitative approach. Political Risk Services Agency applied only qualitative approach. Institutional Investor also applied only qualitative approach. That means that, of course, it's still a field and still an area where we may feel that the assessment of the country risk could be much better improved. Now I want to discuss very different types of emerging capital markets and differentiate between so-called integrated markets versus segmented markets. How we can define the segmentation features? At first, we need to underline that the emerging capital market could be called segmented market, or to some extent independent from the global financial market, because it has very low level of liquidity. We already said that the market in emerging capital market may be really very narrow. It may have very low number of different publicly traded securities. In terms of the industry, very low scope. In terms of the industries, in terms of the companies themselves, and the small size of the capital market as compared to the gross domestic product. There could be a limited number of firms represented by the securities in the market, and really limited number of industries and even sectors of national economy represented in that market, and very limited number of firms and industries could be very sensitive to the changes in the gross domestic product. So from these arguments, we will derive the conclusion about the low liquidity of the emerging capital market, which assumes that this emerging capital market is more or less segmented or not very much dependent on the trends in the global financial markets. The second set of arguments is related to the high level of concentration, which means that among the owners of many large companies, especially among the first 10 large firms in terms of their market capitalization, the proportion of concentrated owners is really very high. Why it is important? The concentrated owners, they are not selling and trading their stocks every day. Then the free float is really very narrow of the stock of the largest firms in terms of their market capitalization. The high concentration of the ownership will mean that the low opportunities are for diversification of the portfolios or for the local investors. And the limited demand on the securities also can exist with this very high level of the concentration. So the market could be concentrated in terms of the companies and their stocks, which represent the biggest proportion of the overall market. The market could be also said that it is concentrated when the ownership in this the biggest, the largest in terms of the capitalization of the stock companies is belonging to the very limited number of owners. So we can continue, of course, listing the features of the segmented market, but how about the consequences? Why it's really important to understand whether this particular market is purely segmented one. Because if the market of some emerging country is really segmented, then it will lead to very high returns volatility due to the arguments I already explained. This segmented market finally may have very low correlation of the stock returns presented in that capital market with the global markets, or it may even have negative correlation, which will mean that the trends in this market are going in some opposite direction than the global financial markets are doing. The segmented capital market will also have a low quality of the board's work, low quality of the disclosure by boards of their work, and the low impact of the boards of directors over the company decisions, the lower power of corporate directors. And finally, of course, in segmented capital market, we will also observe weaker disclosure and weaker quality of the information. On opposite, we may say that some of the emerging capital markets, despite they are not developed ones, but they are emerging capital markets, may be called integrated market. To understand whether some particular market is really integrated, we should go through the list of some criteria which are represented in that slide. If this market is really open as compared to some other markets, if there are some foreign investors buying and selling those local stocks, and this is a strong trend in this particular market, it may be that trend that the foreigners participate in the trades in the stock trades is increasing. It also may have and will have lower transaction costs, which would be comparable to the developed markets. That country will have stronger political stability compared to the developed capital markets. So this market is really dependent on the global trends. It is correlated with the global capital markets, and that means that the globalization will influence investors' decision as compared to the segmented capital market. We may also, and we should also say that if the market is integrated, that market must provide an access and the infrastructure to enter the global markets by the local investors and vice versa. The global investors, foreign investors may have and should have the access and the infrastructure to enter the stock market and other securities in that emerging market, and to buy and sell them more or less easily. And finally, we then have to assume that if the market is already integrated despite still emerging capital market, then the local representative investors, then they can much easier diversify their portfolio, and then for them it is really a smart strategy to relate their expectations on the required rate of return to the sensitivity to the market or systematic risk, because they are capable to diversify unique risk of portfolio of stock away. So finally, to summarize, we may say that among emerging capital markets, we may observe the existence of the integrated emerging markets versus the segmented emerging markets. And then the next very important conclusion, if we have integrated emerging capital market, it's better to say that for this type of market, we should apply the capital asset pricing model when the expected rate of return is dependent on the single asset, which means on the market risk return, which is the market portfolio well diversified. And regardless of the particular country where this stock is traded, if we understand that this particular market is more integrated than segmented, then this is the argument we can apply capital asset pricing model, which says that the expected rate of return is linearly dependent or related to the systemic risk of that particular market. Moreover, we may also conclude saying in this emerging capital market, we may find some representative companies which by the definitions or by these criteria or features that we listed before, which describe the integrated capital market, if they follow those criteria, these particular concrete companies being in emerging capital market, then the analysis of their cost of equity could be based on the idea represented here. It says that we can apply capital asset pricing model almost without specific adjustments to the country risk when computing the expected rate of return for very specific amount and the list of companies which are integrated by their production, by their business model. They have foreign investors and they have foreign representatives in management, and they have even foreign representatives in the board of directors, so on and so forth. On opposite, if we are coming to the conclusion that that particular emerging capital market is mostly segmented, then integrated into global financial markets, then it implies for us that when pricing the equity, when looking for expected or required rate of return for some particular stock of some particular company in such segmented market, we need to account for the country risk. We need to incorporate country risk analysis into the capital asset pricing model. But we also need to be aware whether at that particular segmented market, we really will have local risk-free asset with the representative risk-free rate of return and the local market risk premium we can observe historically in that segmented equity market. And this is very important to understand. These are very different types of markets, very different situations, very different conditions, and then would be very different approaches to capital pricing models. How about the recent evidence if we want to finalize our discussion about the comparison of integrated versus segmented capital markets? Of course, first, many researchers shows that capital markets are becoming increasingly integrated. I just listed few papers here, but of course the amount of papers is growing, and that conclusion is really very smart and important. Next, we also see that the degree of the difference between the local and global capital markets is also decreasing. You see here the paper of 2011, which was made with empirical data of 20 developed and 49 emerging capital markets, that the difference between the global earnings per share coefficient and the local earnings per share coefficients for different industries or averages for industries is shrinking. This difference is decreasing. That's really good sign, saying that the segmented markets are becoming more and more integrated markets. They are not still fully integrated, maybe, but this is the very important positive trend. So the magnitude of the segmentation declines over time, and this is really good news for analytics. The recent evidence also shows that the local segmentation determinants are mostly due to the capital flow restrictions, which still may exist in emerging capital markets, which look like segmented capital markets. The political risk factors are also driving that segmentation, and the trends in the local stock markets are also driving that particular segmentation. Moreover, it's also important to understand, last point on that slide, saying that the investment-grade corporate bond spread in the developed capital markets, in that particular slide represented by the market of United States, are very different from the investment-grade corporate bond spread existing in the emerging capital markets, which are likely to be segmented capital markets. Why? Because just the number of investment-grade corporate bond in emerging capital markets is too low as compared to the developed market, mainly United States market. And finally, the returns on the investment-grade corporate bond, despite their investment-grade bonds, are higher than in the developed capital markets. So the significant difference which still exists between the investment-grade corporate bonds in developed and in emerging capital markets, this is the driver of segmentation still. Now we move forward. We already now understand there could be a difference between segmented capital markets and integrated capital markets within the group of emerging capital markets. And then from that difference follows that capital asset pricing model should be different as well for these different groups of emerging capital markets. To summarize, why should we care about this segmentation at all? If the market is segmented, then the asset pricing model should be based on local returns, and it could become a limitation for application of that capital asset pricing model. If it is integrated, the asset pricing could be based on the global models, global data as well. And then the relationship between the expected rate of return and the market portfolio, which is the representative portfolio for the systematic risk only, this relationship holds for integrated capital markets. For the segmented capital market, it may not be the case. So that's why in many situations, as I will show you in a few minutes later, the asset pricing model can become so-called hybrid. So it can become a compilation, a combination of local and global data in one model. Let's start with the integrated capital market, which is still emerging, but it is already integrated. Or the same approach could be applied to some particular national company in the emerging capital market, which overall as a market is not integrated, but that particular company is already integrated into the global product markets and into the global financial markets. Assume this is a company A, and this is the case because that company has foreign investors buying and selling that stock. It is interesting and it is attractive to the foreign investors. That company may or even should have foreign management conception applied, foreign managers, top managers, in the business model, That company may have foreign owners, foreign managers, and foreigners among the members of the board. Why it's important? Because they are applying some global management styles and management conceptions. So in that case, the capital asset pricing model, which is here called global CAPM, what does it mean? Go please to the right hand side of the equation. First, very important point. We are introducing the global market equity risk premium, which is in brackets here. The difference between the rate of return on the risky portfolio of stock at the global markets, represented by R with the symbols MG, global market, in excess of the risk-free rate from the global market, or so-called representative benchmark developed capital market. In most cases, it would be US market and treasury bond of US government. The beta of the company A would be true beta, the scope of the regression, the slope of the regression, which when doing that regression will be built on the data of the market global portfolio rate of return and the sensitivity of the local company A rate of return of its stock. That's why the beta is marked here with the letters L for the local company A, and G says that regression is built not compared to the local market rate of return, but on the contrary, to the global well-diversified portfolio of risky stock. So this is an exceptional approach because you see here the risk-free rate, which is not national for that particular emerging capital market. You see here the market risk premium, which is not national data. It is the data for the developed capital market, which reflects the conception if that company is already integrated, it is dependent on the trends and on the perceptions of the global investors, and it is dependent on the trends in the global capital markets. And only the beta is like a compromise because the beta on one side reflects the dynamics of the local company A stock return, actual return in some past period, but versus or against the dynamics of the global market risk, equity risk, or market portfolio of risky assets which exist in the global market. What is also important, we can also say that this is an exception, and we need to understand very carefully in which particular situations that exceptional approach could be applied for some particular company A. The company A should have many features of integrated business model or integrated entity inside some integrated to the global capital market. On opposite, that slide represents local capital asset pricing model. It's for the segmented emerging capital markets. And you see many changes here. Going again from the right-hand side, we see here the market risk premium just in local market. So we need to have the data for the market portfolio well diversified in that local market. But remember, we already said if the market is emerging, and even in case of segmented, moreover, there would be some obstacles to diversification, and the investors will have some difficulties to diversify away the unique risk. So the existence of the market rate of return for risky assets in the local market, this is like a specific question. You need at first be sure that this market portfolio is really diversified portfolio. Next, you see here in brackets that we are comparing that model, the market rate of return for diversified portfolio, with the local risk-free rate. But the local risk-free rate itself, as you see here on the right-hand side of the equation, this is a mixture, this is a compromise, this is a combination of the global risk-free rate currently available at the moment of your analysis and the spread between the treasury bond from that particular local market and the treasury bond from the benchmark, which is developed capital market. That spread, default spread of sovereign securities, should be nominated, those securities, in the same currencies, and they should have same or much closer maturities. But they will have different credit ratings. Why? Because the local treasury bond is more riskier as compared to the treasury bond of some developed or benchmark capital market. And again, we see that technical rule. We will use the spread, which is historical average spread due to the difference in credit rating. But we will add it to the current rate of return of some benchmark global risk-free asset. This is a very odious and very unusual approach because we see here the non-local risk-free rate. It's like a mixture, it's like a hybrid. We also see here non-local. We also see here a very interesting approach to understand the equity risk premium because we are comparing market portfolio existing here in the local market with the combination, with the compromised risk-free rate for the local market. And the beta, it's again the product of the regression, it is slope coefficient of the regression of local company A versus the dynamics of the local market portfolio of equity in that particular country. I described that local capital asset pricing model, but I would say that many analysts and many researchers will not believe in the power of that particular model. It's too artificial. So I would not recommend this approach for practical use. One of the problems of that approach for practical use is that it's very much dependent on the country risk. And that's why in some papers, some researchers would recommend to adjust that local model to the country risk and to use the R-squared, which is determination coefficient, when running the regression against some country risk measure. In that particular model, this is the measure which was provided by Morgan Stanley Emerging Market Bond Index. Why we should multiply the second term of the equation, which is on the right-hand side of that equation? Because beta multiplied by the market equity risk premium already has inside the impact of the country risk. Why? Because the return on market portfolio, which is a local portfolio of equity, as I already mentioned several times, incorporates that influence, that impact of the country risk in those returns of the stock which are inside that index, inside that portfolio. So if you are trying to decrease the impact of the country risk over the final result, which is cost of equity of some target company A in the segmented emerging capital market, then the analyst of Morgan Stanley, which is investment bank, very famous, and some other equity researchers would recommend to adjust it in a way shown here. 1 minus r squared, where r squared, this is like a metric, like a measure, which captures the country risk impact when running the regression of the local bonds towards or against the emerging market bond index overall. So this is like a proportion of the volatility of the stock, which is local stock A or target stock in that segmented local market, which is explained by the country risk. And this exercise is made just to escape this double counting of country risk in our estimation. But still we see here that the risk-free rate is a combination of the benchmark rate, benchmark treasury bond return from the global market or benchmark country, and the sovereign spread, which is the historical observed difference in returns between the local treasury bond with the more or less same maturity and the treasury bond at the benchmark market. So the model presented at that slide is slightly better than the previous one, but in any case, it's again really ambitious approach. Now we need to discuss the so-called hybrid models, which is like a mixture between the integrated and segmented markets and a compromise between different ideas and approaches. And the conception of this hybrid asset pricing model is shown here at that slide. You see the standard equation which describes the cost of equity or expected rate of return for some A company stock. And of course, again, on the right side of the equation, we have two different terms. The first step is to use the risk-free rate from the global market. The second step says we need the equity risk premium, ERP here, which is again a product of equity risk premium at developed capital markets and some country risk adjustment. That equation, this is a description of the conception, not just for computation purely. Next very important point. You see here the beta of comparable companies. And this is the bottom-up beta. Remember, few steps before we arrived at that particular part of our class, we discussed true beta versus bottom-up beta. And we said that we can find the unlevered betas of comparable companies and then transform this weighted average beta unlevered into beta levered for some particular company A, just using that company A capital structure coefficient, debt to equity, and that capital company A corporate tax rate. So here we have the beta of comparable companies, but those comparable companies, be aware, they should be found into the developed capital markets. And then we will get them their beta unlevered, and then we will adjust this weighted average beta of comparable companies from the benchmark or developed capital markets by the financial leverage and by the corporate income tax rate of the company A. Because these are different countries, the tax rate may also differ. So we see here a compromise. We see the beta found in the benchmark developed capital market. We see the equity premium for market risk from, again, benchmark developed capital market. We see the risk-free rate, again, from developed capital market. But somehow we need to adjust the computations of the equity risk premium for the country risk. And how to do it? It could be based on different approaches. That slide shows how we are going to adjust within the hybrid capital asset pricing model approach to the country risk. One approach could be based on the so-called spread adjustment. We are going to use the default or sovereign spread of treasury bonds of the local market versus the treasury bonds of the benchmark market. Remember, we at the beginning of the class discussed that to some extent the treasury bills also can be used, but remember, this is much more complicated way if we use the treasury bill, but it's possible. And the second approach, technical approach, how we will incorporate country risk in hybrid capital asset pricing model is based on the relative volatility, which is the volatility of local stock market compared to the benchmark developed capital market, again, stock index from that benchmark market. So this country risk could be found and incorporated by these two different techniques, and the analyst may choose between them. How about the equity risk premium? This should be the mean premium at some chosen benchmark developed capital market, and mostly it would be found from top-down forecasts, as it follows from the research literature. Let's now discuss the first technique, how we are incorporating the country risk premium into the model. Look at the equation, please. Looks like very simplistic, but again, there are some very important points. So the country risk is incorporated by the sovereign spread. Again, I would like to remind you that this spread is derived from the historical observations of credit sovereign ratings for the local treasury bonds or bills and benchmark country treasury bonds or bills. So the risk-free rate on the right-hand side of the equation should be derived from the actual data from benchmark market, and it should be the current rate, which is observable now at the moment of the analysis. But the spread should be the average spread derived from the rating history. The equity risk premium is the premium for the benchmark market. This is the difference between the market rate of return and the risk-free for the benchmark market. This is R with the symbols FG here in that equation. But the betas are again derived from the data from the benchmark market, from the comparable companies, of course, adjusted to the financial leverage of the target company A, which is local company, not in developed market, but here in the emerging capital market. And the adjustment concerns the debt to equity ratio of that company and income tax rate of the target company A. And this is called hybrid approach, spread approach. Almost all components which are the drivers of the expected rate of return, are derived from the foreign market. And only beta has some drivers behind, which are representing some qualities of the local company. And the spread, sovereign spread, also represents the country risk. Empirical results, empirical researches show some conclusions about that technique, how to adjust the capital asset pricing model with the spread approach. Investment bank Morgan Stanley made several research papers on this and made several test beds on different emerging capital markets, as you see here. And they arrived at the conclusion that that technique and the model based with the spread approach to incorporate country risk into capital asset pricing model doesn't have very high explanatory power. And they also suggested that there would be additional adjustments to the model because we need to adjust that sovereign spread to the political risks plus to the corporate governance risk. And this is via internal adjustment factors that they apply in Morgan Stanley investment research. I would say this is more or less possible only for investment bank analytics because we need some very important accumulated data, and for outsiders, it's not an easy thing to do it. Next, we also agreed that the countries can also be incorporated into the hybrid capital asset pricing model by so-called volatility approach. You see here the relative volatility adjustment coefficient, which shows the coefficient which compares standard deviation of the stock return on the market portfolio in the local emerging capital market. This is nominator in the relative volatility coefficient to the standard deviation of the stock returns in the capital market, which is developed or benchmark capital market. That coefficient of relative volatility adjustment would be above 1, higher than 1, because the volatility of the stock market index in the segmented emerging capital market is much higher than the volatility of the equity stock and the market index in any benchmark developed capital market. When adjusting by that coefficient, the equity premium or market equity risk premium, multiplying it as shown here by that adjustment coefficient, which is above 1, we are increasing the influence of the market risk component in that formula and its impact on the expected cost of capital of the target company A, which operates in the emerging capital market. As for beta, this is the same approach as in the previous one. In the spread approach, it's again based on the beta average for comparable companies in the benchmark market, adjusted for the financial average and the income tax rate for that particular target company A. And the risk-free rate is again the risk-free rate for the benchmark market, but no spread now, because this is another technique to adjust to the country risk through the volatility or standard relative volatility coefficient. We can also continue this history of adjustment steps. And remember, we already said that it could be that in some emerging capital market, we may look at some company which is globally integrated, at least in the product market, not in the capital markets, but in the product markets. It means that that company is producing some products which the company exports abroad. And the proportion of the revenue which the company earned here, selling the products here in the local market, is lower than the proportion of export revenue from the foreign markets. So if we now introduce the so-called lambda, or the coefficient, which tries to compare the revenue, the target company A, which we already described as being integrated into the global product markets firm, but originally this is local company A. If we now can compare the proportion of the amount of revenue which company will get from the local markets, selling its products and delivering its services locally here, compared to the denominator in lambda coefficient, to the revenue average that competing companies with the same product portfolio are earning here, selling their goods here in the local markets, if this coefficient is below 1, then it means that the company is less dependent on the country risk factors. The company A is really more dependent on some external product markets than on the local product market. From that follows our assumption and our conclusion at the same time that the company A, in that analysis, if lambda is well below 1, is less dependent on the country risk factors. That's why the third term in the right-hand side of the equation suddenly appears, which is the product of lambda multiplied by the equity risk premium of that particular country. So, what is our assumption here? This is unique company which is exporting a lot of its product, which is very successful in the foreign product markets, which is much less dependent on the country risk. And that's why we should somehow adjust our estimation of the cost of equity, because the cost of equity in that case should be lower than for the companies with the same products, but which have not such a big proportion of export revenue as the company A. Being in the same country, being in the same capital market, trading their stocks in the same capital market, these are different companies in terms of their exposure to the country risk. The company A is less exposed to that local country risk factors than all other competitors with the same product in the same local product markets. Now we need to finalize our discussions about the adjustments to the capital asset pricing model in case we are working with the data for emerging capital markets companies. The first very important comment says that in hybrid approaches as well as in the global approaches, of course, all the data we are trying to incorporate into the model is coming in many cases from the benchmark capital market. And it says that it is not in the local currency for the emerging capital market. Imagine it is from the United States as a benchmark capital market. Then all the data about the returns would be in dollars. How you're going to convert these foreign currency rates of return that you compute finally with the model, which is some of the approaches we already discussed, into the local currency rates. There is a very simple, very clear approach, which is based on the comparison of the inflation rates in a local market, which is local currency inflation rate, as compared to the inflation rate in the benchmark country. The inflation rates are officially published by different ministries in different countries, and the coefficient, the adjustment coefficient that you can see here, helps us to convert into the local currency. We need to adjust the rate of return we already computed in dollars due to application of some of the models discussed at first. And the cost of equity here in dollars is represented by, as you see here on the slide, 1 plus cost of equity in dollars. Then we need to multiply it by the relative coefficient of inflation rates at nominator in local currency, denominator in the benchmark country currency, and finally we have to subtract 1 from the product of cost of equity expressed in dollars multiplied by that adjustment coefficient. And of course, after the conversion, the value for the cost of equity expressed now in the local currency would be higher than the level of cost of equity expressed in benchmark country currency we got from the model. But do remember that if you are making your forecast of free cash flows for your investment or other type of valuation analysis, or even for the economic profit or residual income analysis, you need again weighted average cost of capital, you need again your cost of equity. Remember that when you are applying different models to get the cost of equity or overall cost of capital for any company, just keep your eye on the problem of the currency. If you apply your free cash flows in local currency, then your rate of return must be converted into local currency. One more very important addition to the cost of equity analysis. Many analysts and many researchers would say that after all the exercises, after all the adjustments to the capital asset pricing model, we still need size premium to be added to the overall result. Let's discuss this particular very important question. According to the Ibbotson Associates, which we already discussed as an agency with a long history of observations of market risk premiums, at the same time, they have very long history of observations started from 1926 about the differences in the risk premiums for the companies with the different sizes. When we're talking about the sizes, of course, we're talking about the market equity capitalization. This is the true finance measure for the size of any company. Analysts of Ibbotson Associates, as you see here on that slide, they are observing arithmetic average excess returns for 10 portfolios or deciles of stock ranked by the equity capitalization. And they again are using the New York Stock Exchange equity index when computing market risk premiums. So they are calculating betas on the monthly returns of these 10 different portfolios, which are ranked by the market cap for this very long entire period of observations. The results of these observations year by year are published in a very important, well-known among the financial analysts, so-called annual book on stocks, bonds, bills, and inflation. And according to all these results, which are collected by Ibbotson Associates, if you apply capital asset pricing model without adjustment to the size premium, it will underreport the cost of equity for almost all firms except the largest one. We can illustrate that conclusion by this small table that's like an abstract or extract from this annual book of Ibbotson Associates Analytical Agency. So you can see here in the first row the largest companies in their observations. Those largest companies by the size of their market cap are the top level companies. They have the beta on average 0.9. If we move then lower and lower to the mid-cap companies, they will already have the beta on average 1.12. These are third, fourth, and fifth deciles. And if we go then to the low cap companies, these are 6 to 8 deciles. They will have even higher betas on average, 1.22. And microcap companies are from the least two or last two deciles, the lowest caps, 9 and 10th deciles. They will have 1.38 value for their average beta. So the beta is increasing when the size of the company is decreasing. And it shows the very different market risk exposure of the companies which have higher levels of market capitalization, higher size, says it in other words, as compared to those who have lower sizes. Next, if we apply following the logic of Ibbotson Associates, following their data capital asset pricing model to compute their expected rates of return, they are shown also here in the column with the CAPM excess return. So this is market risk premium. For the largest company, computed market risk premium, which is the product of the overall market risk premium and their betas, is 6.75. But their actual excess return, which is the market risk premium over the risk-free rate, is lower. It's 6.38 annually. So when we now subtract the CAPM result, which is computed result, estimated result, from the actual excess return, we will get size discount, which is minus 0.38. And it shows that we are now observe the situation when the largest companies will have a little bit lower rates of return than the companies with a small cap. And you see from that table that the size premium is increasing for other deciles, except the largest ones. If we now go further, so we discussed now how Ibbotson Associates looks at the size premium and what are the values for the size premium according to the analysis. Remember, they are applying this technique for the data starting in 1926. PricewaterhouseCoopers, global company, has also its own vision of these size premiums, but that company analysts apply 25 groups instead of 10 groups of companies, ranking them by market capitalization. That's the first very important point. And the second point says that, of course, they're not looking for such a long period of time. They started this research in 1963, and of course, they continue researching for the influence of the size of the company in terms of the market cap on the market risk premiums. The very important criteria or difference between these two agencies also is related to the criteria they are applying to rank the companies by the groups. So they also apply market cap, but they rank the companies also with the additional criteria listed here on that slide. And you see here book value of equity, market value of even permanent capital, which is the sum of long-term debt capital and the equity capital. Book value of capital employed, average earnings before interest, tax, depreciation, amortization expense, which is computed for 5 years. By the sales revenue, by even employees, number of employees. So they apply different criteria to express the size of the company, not only market cap, as Ibbotson Associates. And they are trying to study the size premiums for different rankings built by these different additional criteria. And their conclusion is shown here on that slide. The size premium holds for all types of rankings with all types of the criteria, but the value of the size premium when we are applying different types of criteria, of course, is a bit different. If we compare now the results of Ibbotson Associates versus the results of the research group of PricewaterhouseCoopers, then we may say that Ibbotson Associates has the arithmetic average excess return over the risk-free rate about 5.07% for the large companies, and it's much higher, even twice higher, 10.7% for small cap companies. As for PricewaterhouseCoopers data, when ranked by capital employed, book value ranking, and by sales revenue ranking, they, as you see here, have more or less similar values for the size premium, starting from 4.64 for capital employed and 6.4 for sales revenue ranking for the large companies, which is comparable to the 5.07 for Ibbotson Associates. Nevertheless, Ibbotson Associates applies different type of criteria. For the smallest companies, the difference is not as low as for the large companies between two agencies you see here. But remember, PricewaterhouseCoopers uses 25 groups. So the small companies in terms of the PricewaterhouseCoopers are even much smaller in size than Ibbotson Associates has in 90s, is 9 in 10th deciles. So why it's important to understand? It's important because the size matters when computing cost of equity, and then you as an analyst have to follow some particular approach. You may stick to Ibbotson Associates or you may stick to PricewaterhouseCoopers, but you should understand that the size is really important. We discussed cost of equity and different aspects of the analysis of cost of equity and application of capital asset pricing model. But it's time now to switch to the cost of debt. And there are a few points and few comments really very important. I would like to attract your attention to that question. Why do we need synthetic cost of debt? So first, let's summarize what is default risk. It means that the borrower may default, not be capable to pay regular interest payments, or even not be capable also to pay the principal amount of debt. And default risk is, of course, the result of the firm-specific drivers of the risk And of course, these firm, unique or specific features and drivers of the risk may affect all the promised returns in case the company issues corporate bonds or in case the company has some bank loan still not redeemed. When we are talking about the default risk, we need to understand that it has a so-called limited upside because the debt holder will get the maximum amount from the company, which is total nominal value of the corporate bond or the total nominal value of the bank loan still not repaid. But the very big or even greater downside effects of all these drivers of the debt. So say it in other words, if everything is okay, the debt holder will have the limited upside. It will not get, or he or she will not get back amount higher than the nominal value of the debt. But if something wrong is with the company, with the borrowing company, and these firm-specific drivers of the risk will have negative impact on the company, then the borrower suffers a lot. And then the debt holder also suffers a lot because he or she will not get interest or coupon payments in time or even at all. And then there is still uncertain situation with the principal repayment. And the capacity to escape for the borrower, the default risk, of course, depends on the cash flows generation capacity, on the stability of the future cash flows, and of course, it is very important to understand the liquidity of the firm's assets. So when the analyst approach the analysis of the overall cost of capital, and he or she needs also the cost of debt, and he or she looks at the company which doesn't have corporate bonds outstanding, but it has the bank loan, it's very important to understand how to escape the mistakes in the cost of debt analysis. What could be the potential mistake? The first very important point says that there are some, let's say, evident costs because each bank loan agreement has some fixed information about the interest rate due to the terms of the contract. But the analyst should not just follow this particular data. Why? Because there would be and there should be some changes in the demand and supply for the bank loans of that type in that market. And there would be some changes in the risk drivers of that borrowing company as compared to the period when the agreement with the bank was written and signed. So when you need to analyze the cost of debt, you need to understand the current market interest rate for that company. Nevertheless, the bank loan was given to the company some years ago. But you need to understand the current position, the current risk level of the company, and to assign the current market rate as if the company is going to borrow just now for the residual period of time of the bank loan for this particular company. And this is not just a very evidence thing. You need to apply some specific approach. Finally, your cost of debt is a product of this current market interest rate. Here is denoted as I, interest rate, multiplied by the tax shield coefficient, 1 minus corporate tax rate. If the company has corporate bonds outstanding, then the analysis is really very simple because the corporate bonds are traded and the changes in market prices of bonds are influencing the yield to maturity. And then the yield to maturity, this is the true cost of debt for that particular company. But again, just we need to remember this. We need to escape the desire to use the so-called evident costs, or the coupon rate which is fixed, which is stated in the prospectus for corporate bond issue when it was made on the market. Why again? There are some factors that may change the demand supply in the bonds market, some factors that may change the risk profile and the risk level of the company. In this case, the cost of debt is a product of yield to maturity multiplied by the tax shield coefficient. Remember, the yield to maturity, this is something which is volatile, which is something which is not fixed. It depends on the market situation. It depends on the demand and supply. It depends on the perception of investors of the risk level of the company with this corporate bonds outstanding. If you think in terms of the accounting, you may say, no, it's wrong, because the company is still paying the same coupon rate as it was stated in the agreement. But this is the accounting vision. It's not a finance vision. The finance vision, remember, we talked about it just in the first class in our course, should be based on the risk analysis, on the risk level. And that's why it would be really very big mistake if you just take the coupon rate and multiply it by the tax shield coefficient. You need yield to maturity as the rate of return, which is dependent on the market prices of the bond, and the market prices themselves are dependent on the perception of the current investors which are trading that corporate bonds in the market about the risk level and the risk drivers of that particular issuing company. Then, if you do not have corporate bonds outstanding, in many situations you will need to apply some homemade rate or so-called synthetic rate for the company to analyze the cost of debt. The step number 1 says you need, of course, at first a risk-free rate, which should be treasury bond, with the maturity which is close to the investment horizon within your analysis, within your valuation procedure. Plus, you need firm default spread. If you have your corporate bonds outstanding, they will have their rating, then this procedure is not applicable. But if you do not have corporate bond outstanding, then you need this homemade default spread, or so-called lightly rating. How you are going to get it? You are going to get it from the history of rating groups, because to each rating class you have to observe some average yield to maturity for corporate bonds of the companies with the credit ratings. So from the history of credit ratings, you are capable to get the data about the firm default spread belonging to some particular rating class. But you do not have for that company your corporate bonds outstanding. That means you do not have, of course, your official credit rating. Then you need to get some likely rating. How you're going to do it, I'm showing on the next slide. But another problem could be if you don't have your risk-free rate local, you don't believe the treasury bonds behave as they are risk-free, as they are very volatile. I mean, the return on corporate bond local could be really very volatile, and you as analysts maybe do not believe the local treasury bond is representing really true risk-free asset. Remember, in the capital asset pricing model for emerging capital markets, when we needed the risk-free rate, we also applied a risk-free rate from the benchmark or global risk-free rate, and then we added the sovereign spread. The same type of steps should be here. And in the formula number 2 here on that slide, we are making these 2 first steps to get the substitute for the risk-free local rate with the help of the sovereign spread historically observed. And the third step would be the default spread, also historically observed from particular ratings. How we will get this likely rating? What we can do with this? The rating procedure, credit rating procedure for any debt issuer, of course, is not a very simplistic exercise. It should be full of very many factors for qualitative analysis, qualitative resources approach, qualitative data, not only quantitative. But the other part of the whole rating exercise also stands on the analysis of quantitative data from the company and mainly different types of their financial ratios. On that slide, you may see the very important conclusion derived from the actually existing ratings. You may see that the lower the rating, let's say beyond below BBB, these are not investment grade ratings, the higher the default spread, which remember is the difference observed historically between the actual rate of return on corporate bonds of particular companies within particular rating group minus risk-free interest rate or risk-free treasury bond rate. You see here on the slide for 2020, this is very low rate of return for the risk-free asset. So if you apply that risk-free rate for risk-free asset, and let's say if you think that after your analysis that your target company, which doesn't have its own credit rating, which doesn't have its own corporate bonds outstanding, it has only a bank loan, let's say it is likely to have A minus, then you have the observed default spread, which is equal from that table, you may see it, 1.33%. You will add these two numbers and you will get potential interest rate or potential yield to maturity homemade for this particular situation, because that company you are looking for, the target company, it doesn't have corporate bond outstanding, doesn't have officially assigned credit rating. So how to get that a likely rating? We need to remember that there are again observations in the history of different rating groups of different credit rating agencies for the quantitative data as well. And that piece of the data explains and shows the differences in interest coverage ratio shown here. And that slide, the minimum and maximum historical values for that particular financial ratio comparable to different rating groups and classes. You see, if you compare AAA with BBB, you see how dramatic is the difference. AAA, they will have minimum values for interest coverage ratio above 8.5. So 8.5 times earnings before interest and tax of companies with a AAA credit rating. These are the top level companies in terms of their credit quality, is higher than the interest expense annual they have to repay for the debts. If you go to the BBB, which is the last credit rating group for the so-called investment grade bonds, the minimum value for the same coefficient interest coverage ratio is 2.5 and the maximum value is 2.9. And you see, if you go then to CCC, which is just almost the end of the rating table, you see how low is the interest coverage. Remember again and again, these are historical observations. We can just enlarge the representation of different financial ratios by rating groups. You can look here, BBB is here underlined by the red color just because this is the last investment grade rating. Those companies with the BBB, these are more certain companies for investors, less risky companies for investors. BB, these are already risky companies for investors, so on and so forth. You can see here in the first column the list of different ratios, how dramatically they are changing with the change in the rating group, in the rating level. You continue that list of the coefficients. You can see here very different coefficients and they are changed. Let's say funds from operations. This is again the coverage ratio. The highest levels are assigned, of course, to the highest ratings because these are very sustainable, solid companies, and the history of observation of the financial ratios for these companies show that the funds from operations, which are earnings before interest, before depreciation, and before amortization, divided by the debt of the company, is 60 times higher than the level of the debt of the company. But for BBB, it's almost 28%. And then to CCC, it's very, very low coefficient. You may also think about the other coefficients in the table. Look at the operating margin, which is profits to sales. You may see that the companies which are in highest credit ratings, they will have higher levels of performance measured by the operating margin. And the companies in the group which is beyond BBB will have dramatically much lower coefficients of their operating performance. So what we can do from here, we can just apply this approach, compute the major coefficients showing the financial leverage of the company, showing different coverage ratios which were represented in the previous slide and then that slide, the ratios for company performance, different operating and different other margins, and then we can understand to which particular rating group, according to these ratios, to these financial ratios of the target company, it can fit. And it's called homemade rating because we do it ourselves by our hands. We relied, of course, we used the historical observations, but we didn't do the overall complex qualitative plus quantitative analysis that the rating agency would apply. That's why I'm calling it homemade rating. So we discussed a lot about different components of overall cost of capital. And to finalize our discussion, I would like to summarize and to show you the models of finding the minimum cost of capital, bearing in mind weighted average cost of capital for sure. It's important to understand how we can do it after we discussed all the components, because in many situations, in practical business situations, the finance person or the finance analyst should understand how to find the target capital structure at the firm level. When we discussed the topic on capital structure, mostly in theoretical framework, I showed you the empirical researches on the target capital structure and the drivers for the adjustment costs and the determinants for the capital structure for the samples of companies based on different countries in different industries, and the results of empirical research of different academic people who observed different periods and different countries and situations. But what I'm doing now, I'm showing you the approach for some particular company, and I actually write here, this is the simple model. This is not a big deal, but it's a summary of everything we already learned about the overall cost of capital. So the first approach, the most simplistic, but still you need to understand it to my mind, is so-called rating approach. It's based on the idea I previously, a few minutes ago, showed you, the so-called homemade or likely rating that you need to assign yourself or just to understand yourself because you need the current likely market interest rate for the cost of debt of your company. So the whole story is about if you are going to change your capital structure, you need to understand at which particular debt to equity coefficient of the capital structure expression you will get the minimum level of the weighted average cost of capital. Why it's important to understand the minimum level of weighted average cost of capital? Remember, this is the benchmark. This is the hurdle rate. You need to overcome that hurdle rate in your all investment decisions in the company. Remember, I already started the whole class saying this is the measure of the success, of the professional success of any top management team of any company in any industry. So this is very important now to understand which particular minimum level of weighted average cost of capital you can get when changing your capital structure. And this is the most simple exercise that I'm going to show. So the introductory stage, this is your assumption. I'm changing the capital structure step by step. And for each iteration, for each level of debt to equity coefficient, I'm going through this algorithm. So I'm going starting from the step 1 up to the end of the whole story. So the step number 1 will mean if I'm changing capital structure, I'm raising financial leverage. So my debt to equity coefficient is going to be increased by some value. So at that new level of financial leverage, what about the likely rating? How would look like financial leverage ratios because we're changing the capital structure, and whether the coverage ratios are also going to change. After we understand the potential changes in these two sets of the financial ratios and coefficients, then going back to the rating tables, pieces of these tables I showed you in a previous point of our discussion, we can assign, especially with the coverage ratio, the likely rating, homemade rating, to the potential debt of the company, and this is our assumption. When assigning the likely rating just only by the help of the financial ratios, we can move towards the second step in this algorithm. Then we again are going to the rating tables. Remember, we started with this idea, which show the historically observed default spreads which are assigned to each rating class, to each rating group. After the step number 1, you have your likely rating class. In the step number 2, you will get your likely default spread. And if you add your likely default spread to the current observed at the moment of your analysis risk-free rate, which is Treasury bond in most cases, then you will get your likely market current interest rate. Next, third step. Of course, you need to apply your tax shield coefficient. You need to multiply the product of your step number 2 by 1 minus corporate tax rate. Again, the effective corporate tax rate, which reacts to the level of interest expense, which shelters the income against taxation, it also can be observed how the effective tax rate is changing when the rating of the company, the rating group, or the rating class is changing. So the relationship between the effective tax rate, not nominal, not marginal, but effective tax rate, and the rating class is also observable from the history of rating, credit rating analysis. The step number 4, this is the answer to the question, what is your potential cost of debt at this new level of capital structure? The step number 5, you are now moving to the cost of equity analysis. You need to understand which particular capital asset pricing model you have to apply. We already discussed the different aspects of that not very simple question. So you will finally make some solution, which particular approach, which particular version of modified capital asset pricing model if you are looking at the emerging capital market, or which particular capital asset pricing model approach you will apply even at developed capital market. You will need, of course, here the beta. You will need beta unlevered because you are changing your capital structure, and you will get at first beta unlevered, which will show you as if you do not have any debt financing in your capital structure, which will capture only your operational risk. And then you will again adjust the unlevered beta with the new level of your debt to equity coefficient. And remember, your corporate tax rate, the result of the step number 3, can also change with the change in the capital structure. Now you are well prepared to go to and to move to the step number 6, which means that you already have a cost of debt, the result of the step number 4. You already got your cost of equity, the result of the step number 5, and you have now new weights for the debt and for equity because you are changing your capital structure. So you will compute at the step number 6 your weighted average cost of capital at the new level of debt to equity. It's not the end of the story. At the step number 7, you need to go back and to build again and again all the steps and to go through them, and then to build your weighted average cost of capital curve, because you will get different values for weighted average cost of capital at different levels of your debt to equity, the coefficient which measures your capital structure. And you will get to that type of a curve somehow. On the horizontal axis, you are moving to the right, increasing your debt to equity coefficient. On the vertical axis, you will get your new values for the weighted average cost of capital. This is according to the algorithm I showed you. Somehow you will arrive at some corridor, at some interval, which shows that your weighted average cost of capital stopped decreasing. That means that you already found by your computations, with some assumptions behind, we still didn't discuss all these assumptions, but we'll be back to them in a few minutes, you already found your minimum level of weighted average cost of capital. Moving to the right, increasing again the debt to equity may now provide you with the increased value for the weighted average cost of capital. At that point, you will stop, because now you have your minimum level. You now know at which debt to equity coefficient you finally got to that minimum weighted average cost of capital. And then you need to go back to some important assumptions, because these are only computations, and they are now showing with some particular value for the debt to equity coefficient, you will get minimum level of weighted average cost of capital. But the overall analysis says we are looking for the target level of capital structure. Why? What was the reason? Because we want to get maximum value of the company. So the story is now resulted in the minimum value of WACC, or weighted average cost of capital. But to get the maximum value, we need to understand the assumptions behind the analysis. How about the assumptions? This is the list of very important assumptions. We have to assume that our financing policy, when we are increasing debt to equity ratio, does not influence our operational policy. Remember, in the classes about capital structure conceptions, I showed you that there exists some relationship between the level of the debt in the capital structure and the reaction of all stakeholders of the company. And that reaction could be negative when the company is increasing debt to equity coefficient. And that negative reaction will bring the changes in operating policy to the company and the performance of operating policy of the company. So the assumption number one here is just some artificial assumption, of course, saying that in any point of time, at any value of debt to equity coefficient, our financing policy does not impact operating policy. It will not be true beyond some point in your debt to equity coefficient. But here we are ignoring that break-even point. The assumption number two says we are not assuming that the company is growing. That's why we are assuming that all the earnings earned within some particular business cycle within the year, 100%, they all would be distributed to shareholders in dividends. And that's why the assumption number three also says the earnings before interest and tax are permanent, they are constant, because we think in terms of the no growth strategy of the company. If the company is growing, then the company should use the accumulated earnings to investment decisions to finance some investment projects. But in the point number two here, we're assuming that the company is distributed all the earnings earned and not accumulating all the earnings and even partially not accumulating the earnings. Now, this is really simplification, of course. The point number four says the market value of the debt does not deviate from the book value of the same debt, which is shown in the company balance sheet. It's again some artificial assumption, because if there are the changes in the operations of the company, and even if there are the changes in the financial policy of the company, it may lead to the changes in the market value of company debt. Again, this is too strong assumption, but it's still here in that list. The assumption number five says we are using book values of the debt and book value of the equity to compute the weights for debt and weights for equity for weighted average cost of capital. Again, this is too strong assumption. And the point number six says if we found some financial leverage, then applying this homemade rating approach, we are capable to estimate the likely market interest rate for company's debt, and then we're capable to estimate the cost of debt finally. Why we are listing these artificial in many situations assumptions in that slide? Because we already got minimum level of the weighted average cost of capital, but our final message is to get the maximum value of the company. And it's possible if we are now can conclude that the free cash flows of the company in process of changing the debt to equity coefficient, in process of increasing financial leverage of the company to get the minimum level of WACC, the free cash flows stay the same. If we do not apply these assumptions, then the model must become much more complicated. We need different scenarios. We need different functional relationship between the parameters we already discussed. So we can extend that simple model. It's not a big deal, but it's some steps forward to get the answer to the question about the target capital structure of some particular company. We can also introduce several steps. Some of those steps are just a replication of previous approach, but we can also add additional steps following this logic. The first step again is about the permanent level of earnings before interest and tax, or no growth strategy. The second step says we need to find the interest expense, the current market interest rate for the companies. We need then to find cost of debt. We need, of course, to find cost of equity. This is very similar to the previous approach, but the step number 6, it's something new, because now we ignore the assumption that the book value of the debt is equal to the market value of the debt at each point in time of our analysis of that target company. So on the contrary here, in this step number 6, we are going to say we need to find the market value of the debt. With the previous assumptions, because it's no growing company, we will say that at that particular level of debt to equity coefficient, at that particular level of financial leverage, the amount of interest expense stay the same, and this is an annuity for us. And remember, we can find the value of the debt of the company if we capitalize the interest expense, which is annuity cash flow stream, by the cost of debt of that particular company. At the step number 7, almost the same, very similar procedure we have to apply to find the market value of the equity, because now we are assuming no growth strategy, no investment, no accumulation of earnings. We are again assuming that 100% of all earnings are distributed in dividends, and the dividend stream becomes an annuity cash flow, and we need to capitalize or to divide the dividends, which are now permanent, they are fixed, they are annuity, by the cost of equity that we found at the step number 5. So the step number 6 and the step number 7 are similar in terms of the assumptions. No growth strategy will lead to no changes in the interest expense in monetary terms. They become constant, all these payments to debt holders, and in dividends, they also become constant and each time equal to the earnings before, after interest expense, and after tax. So, to continue the extended model, now we need to get a sum of the value of equity and the value of the debt. This is the step number 8. And the step number 9, which appears here, looks like something unusual, because if we are not no growth company, we are pursuing this assumption, no growth strategy. When we increase financial leverage, we need to buy back or to issue new shares. So we need to understand how we are going to escape the increase in the total capital, because the change in debt to equity ratio should mean that the amount of debt is increasing, but the amount of equity is also decreasing at the same time. So we need to understand how much would be the earnings per share. So we need to understand the changes in the earnings per share. For that particular purpose, we need to make an estimate of the new shares to be issued. How we can do it? So we can say we now know how much is the estimated change in the amount of debt. And we can say that we now can see the current price per company's shares. So now we are thinking in terms of how many shares we would issue in addition if we need to attract the amount of money which are equal to the change in debt of the company. Dividing the amount of change in the debt of the company by the price per share currently observable in the market, we will get an estimate how many shares should be issued in case we wanted to get that financing through the equity financing. But then it will also influence the earnings per share, and we will need to calculate the new coefficient for earnings per share. Remember, no growth strategies and earnings before interest and tax are the same. The interest expense is the same, so the earnings which are available to be distributed between among shareholders at that level of debt to equity coefficient would be the same. They will be also permanent. But we should now divide them by the new amount of shares issued. And the shares issued would be lower than they were before because we are attracting additional investments, additional capital through debt, but not equity. We went through the step number 9, artificially trying to understand how many shares we can get back from the market, let's say. This is like issue in brackets. Now we are going to subtract them from the amount of shares outstanding because we're increasing debt. We should not keep equity the same. So the step number 10, this is our estimate about earnings per share when earnings are still the same, no growth strategy, but the shares outstanding, I'm talking about common voting shares outstanding, their number decreased. And therefore, earnings per share, EPS, increased. The step number 11 says, now we need to understand how the price of common shares increased. How we can get it? We now got, after the step number 10, new value for EPS. It's increased because we are assuming the same amount of earnings are distributed between the decreased amount of shareholders or shares outstanding. So now if we can assume that EPS at that particular level of debt to equity stays the same, it again becomes an annuity, and we can find the price per share. How? We will divide EPS, the new value, the result of the step number 10, by cost of equity, the result of previous steps. Finally, what we've got? We've got new value for weighted average cost of capital because we changed the weights for debt and equity capitals. We got new cost of equity at new debt to equity level. We got new cost of debt with the help of likely rating analysis. So we've got new weighted average cost of capital. As the result of the step number 8, we've got total market value of the business. As the result of the step 11 and 10, we've got the new price per share. So we now can find the optimal or target level of capital structure for that particular company, applying not only one criteria as in the previous step with the minimum weighted average cost of capital, but 3 criteria simultaneously. Minimum weighted average cost of capital, maximum price per share, the result of the step number 11, maximum value of total capital of the company, the result of the step number 8. If 3 criteria listed here are applied, then we can say at that point of debt to equity, when we've got maximum value, maximum price per share, and minimum weighted average cost of capital, we will get the target level of capital structure. But this is again the computational result, a little bit more complicated than in the previous approach. This a type of an extension to the previous model, but again we need to be back to the assumptions because remember we implied some more or less artificial assumptions to move forward through the steps. Of course, I would like to say that all the illustrations for today's class will be provided in supplementary materials, numerical examples, and calculations. Additional materials will be provided for those who join us at the degree program. But to finalize the overall class, I would like to make a summary and provide you with some takeaways. Now it's time for takeaways, and this is lessons learned from the topic. That slide starts with the idea, which is too important, really very important in financial analysis in the model which is due to the principles of corporate finance. The overall cost of capital, this is key benchmark metric to make a judgment about the performance, about the potential efficiency of investing decisions, about all strategic deals the company is going to undertake currently or in the future, about the company valuation in many situations. What's very important, the key benchmark, which is overall cost of capital, should be also applied to the closely held businesses, not only publicly traded. And it says now that the key benchmark in terms of the overall cost of capital, which is weighted average cost of capital, again is a very important measure for professional success of any management team, even in closely held, even in family businesses. Second very important lesson that we have to learn from that class discussion: when determining the cost of capital of the company, the cost of debt and the cost of equity, we need to capture the current risk perceptions. In some situations, it's not very easy, but we must. This is our professional requirement. We cannot rely on some agreements, we cannot derive the data, extract the data from some written and signed agreements. We need to understand the current risk level, how it could change, if any, so on and so forth. Third very important lesson, because weighted average cost of capital, of course, is functionally related to the drivers of the risk of the company, operational risk or business risk, and financing risk. Then, when we understand that risk level can be changed, this is background to understand how we can find the target or optimal level of the capital structure of some particular company, because many strategies of the company will require to bring some changes in the capital structure planning. To optimize that process, we need to apply some modeling of weighted average cost of capital, and I showed you a very simplistic approach. Then I extended that simplistic approach, adding some additional criteria, and of course, this is not the end of the whole modeling story. We need to understand and we need to discuss in the future more complicated, more sophisticated financial models to solve the problem of optimal capital structure planning for any company, because the competition, the situation, and the business model cannot be fixed, cannot be permanent. It is going to be changed in many situations. The fourth very important lesson that we must learn in that topic says that, of course, there could be a variety of models to plan the capital structure changes with more sophisticated assumptions than those simplified we already applied. On that slide, I would like to focus your attention on the lessons learned for some particular very specific problems. We already discussed risk-free rate, how it could be chosen, what are the possible mistakes and dangers, analytical, that we can face, market risk premium, size premium. So we need to be aware that we really understood the importance of these details. We already discussed how the cost of debt should be found for companies which do not have currently bond outstanding, and they do not have yield to maturity on their corporate bonds, and they do not have officially assigned credit ratings by the professional rating agencies. As for emerging capital markets, we also discussed the complicated story behind the problem of the risk-free asset in the national local market, especially segmented emerging capital market, and the need to understand the specific of some business model even in a segmented capital market for some particular types of companies, and the opportunity to apply integrated approach even in case the company is in a segmented emerging capital market. We also looked at some specific features of those companies that could be differentiated in terms of the analysis of cost of equity from the majority of the firms in the segmented capital market. Be aware you understood the arguments, the conceptions, and once again, the numerical examples, some real data from the capital markets would be provided for you just to go through these exercises and to be closer to all these equations and formulas we discussed today. And as always, I wish you a success in my course, of course, and in your professional development. And I do think and do hope that many of the participants who join us in this open content part of our course will also join us in the degree program at our University High School of Economics. Thank you.